I can't predict recessions. If you guaranteed me there would be a recession next year, I would be buying and selling the same securities I'm buying and selling today.
Successful investing is hard work because it means disciplining your mind to do the opposite of human nature. Buying during a panic, selling during euphoria, holding on when you are bored, and just craving a little action. Investing is 5% intellect and 95% temperament. Whether new to investing or not, listening to Warren Buffett will surely set you apart. Warren Buffett boasts a long and impressive track record as a successful investor. As we anticipate 2024, a period many financial experts predict to be marked by a recession, let's delve into some valuable investment tips inspired by Buffett.
But that's what intrinsic value is about. You know, if you buy a McDonald's franchise, if you buy General Motors, whatever it may be, the real question is, A, are you going to have to put more cash into it after you buy it? But it's really cash in, cash out, when, what discount rate, all the standard stuff.
Number 1. Prioritize firms with intrinsic value. Buffett emphasizes the importance of investing in companies with intrinsic value. To put it simply, choose businesses that offer something essential or unique. A stock's intrinsic value is its fair value. However, Buffett refines this concept by calculating a company's intrinsic value, derived from its expected net income over its lifespan, minus an appropriate discount rate. Buffett favors companies with a history of consistent earnings growth, making it easier to estimate future earnings. He then discounts the projected earnings by the long-term government bond rate. Take Apple, for example. Although its products have a higher price tag, customers are drawn to the brand, not just for the devices, but also for interconnected services like Apple TV and Apple Music. Investing in companies like Apple, with a solid foundation in customer value, can be a wise move. Even if market conditions fluctuate, these companies weather the storm well. Number 2. 2024 might be the best time to invest. When interest rates are low, it's easier for people and businesses to borrow money. This encourages more spending, boosting profits, and raising asset value. Imagine it like gravity. When it's low, things weigh less and can rise. If interest rates go up in 2024, assets may become less valuable. This could be an excellent investment opportunity if you have money saved. Bear markets present a favorable opportunity to purchase stocks. Recessions typically stem from a sluggish economy, often tied to higher interest rates. Higher interest rates can reduce asset values, so your stock portfolio may decline. Considering himself a net buyer of stocks, Buffett acquires more than he sells. If you're confident in selecting and holding stocks, 2024 might offer a chance to acquire stocks that could be outside reach. Nevertheless, you have to know that building wealth is not magic.
Stocks are safe for the long run, and they're very unsafe for tomorrow. Berkshire, 3 times since I took over, has gone down roughly 50%. Did I feel poor then? No, not at all. I knew it was going to be worth more over time. American business is going to be worth more over time. That's what you're buying as a business. You're not buying a stock. You're buying a piece of a whole bunch of businesses. Are those businesses going to be worth more 10 or 20 or 30 years from now? Of course they are. But if you think you can jump in and out, or that you know the time to come in, I think you're making a mistake.
Number 3. Give your investments time. Warren Buffett suggests having 3 to 6 months savings for emergencies before investing. This becomes crucial, mainly if there's an impending recession, as might be the case in 2024. Why the emphasis on savings? Well, you can't respond to every market fluctuation. The key is to invest and let your investments sit for at least 7 years, allowing the economy to go through its natural cycles of ups and downs. Buffett's investment strategy centers on long-term commitment, emphasizing the crucial quality of patience. According to Robert Johnson, a Berkshire Hathaway shareholder and finance professor at Creighton University, patience is the key to investing like Buffett. Buffett has reiterated this philosophy, stating that when purchasing stocks, the focus should be on the business's long-term prospects. He was willing to hold on to stocks even if the market were to close for a couple of years, emphasizing the analogy of buying a farm. Much like assessing a farm's long-term productivity, Buffett encourages investors to look beyond daily price fluctuations and concentrate on the enduring value of the businesses they invest in. As humans, there is always the temptation to follow our emotions, but you have to steer clear from this.
What you do need is emotional stability. You have to be able to think independently, and you have to be, when you come to a conclusion, you have to really not care what other people say and just follow the facts and follow your reasoning. And
Number 4, do not be guided by your emotions. Buffett emphasized that stocks are suitable only for those who are psychologically and emotionally prepared because they aren't short-term investments. The economy is dynamic, with fluctuating interest rates and other forces influencing the stock market. If you can't resist frequent intervention, you should refrain from investing your money in stocks.
The most important thing is to be able to define which ones you can come to an intelligent decision on and which ones are beyond your capacity to evaluate.
5. Invest in what you have an understanding about. In recent years, numerous new investors have entered the stock and cryptocurrency markets without a solid grasp of their operations. Warren Buffett consistently urges investors to refrain from pursuing every attractive opportunity but concentrate on those they comprehend. The genuine risk lies in investing in something, and you need to understand what, where, and why you're investing. For instance, Buffett refrained from investing in tech stocks until 2016 due to a limited understanding of technology. It was only after thoroughly grasping Apple's business and growth potential that Berkshire Hathaway acquired a stake in the company in 2016. Buffett's advice is clear: never invest in a business you cannot understand. In a 2019 CNBC interview, he stressed the importance of learning to value businesses and distinguishing those within your expertise from those outside. While he doesn't expect investors to be experts on every company, Buffett emphasized the crucial skill of accurately evaluating selected businesses in his 1996 annual shareholders letter. The key lies in recognizing your circle of competence and making informed investment decisions based on that understanding.
my dad had various nicknames for me. He'd call me Fireball sometimes because I'd start little businesses. He didn't care about money at all. He believed very much in having an inner scorecard and to never worry about what other people are thinking about you. Just if you know why you're doing what you're doing, that's good enough. When I want to do something, I always want to do it big. I've said many times that 65 or 70, and the people that you want to have love you actually do love you, you're a success. Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because your stock goes down, you shouldn't own a stock at all. The first books I read on investment were actually in my dad's office. I just read and read and read. I probably read 5 to 6 hours a day.
I mean, I figured out very early, you don't have to be that smart at this business, which is fortunate, but you do have to have the right temperament.
The best gift I was ever given was to have the father that I had when I was born.
Number 6, dare to be different. Markets operate in cycles of greed and fear, and Warren Buffett is an investor who has fully navigated these cycles, encouraging others to do the same. A good example is the 2008 global economic meltdown, when fear cast doubt on the long-term prospects of many businesses. Buffett seized the opportunity to quickly invest in blue-chip companies like GE, Goldman Sachs, Bank of America, Mars, and Dow Chemical. This move, estimated in 2013, reportedly yielded a profit of over $10 billion. In his 2018 shareholder letter, Buffett emphasized that seizing opportunities doesn't demand exceptional intelligence or an economics degree. Investors genuinely need the ability to ignore crowd fears or enthusiasms and concentrate on a few fundamentals. Every successful investor must be willing to appear unimaginative or even foolish for an extended period. Buffett advises against following the popular opinion. If you can separate your emotions from your investment decisions, you can unveil more profitable opportunities. As Buffett puts it, what investors need is an ability to both disregard mob fears or enthusiasms and to focus on a few simple fundamentals. This underscores the importance of rational decision-making and focusing on fundamental principles rather than succumbing to market trends driven by emotions.
You're not going to know it because it doesn't show up under conventional accounting. But omission is way bigger than commission. There's big opportunities in life have to be seized.
Number 7, always be ready to take advantage of opportunities. Every decade or so, dark clouds will fill the economic skies and they will briefly rain gold. When a downpour of that sort occurs, it is imperative that we rush outdoors carrying wash tubs and not teaspoons, Warren Buffett once said. Buffett strongly believes in holding on to money when it's cheap and spending it aggressively when it's expensive. This approach was evident in 2000 and 2008 when critics questioned him for holding on to billions in cash instead of investing in stocks. They didn't realize that Buffett was preserving that cash to deploy when companies dropped from excessively high prices. Number 8, cheap doesn't mean profitable. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price, says Warren Buffett. Having learned from Benjamin Graham, renowned as the father of value investing, you might expect Warren Buffett to favor companies available at a low cost. However, due to early mistakes in acquisitions and investments, Buffett recognized that a low-price business might translate into something other than a profitable investment. When Buffett bought Berkshire Hathaway, it operated in the textile industry and was priced significantly below its book value.
The value of American business depends on how much it delivers in cash to its owners over between now and Judgment Day, and I don't think it changes in 10% in a 2-month period if you're looking at it as a business. Now you've got anything can happen in markets. I mean, anything can happen in markets, and that's why they don't ever borrow money against securities. That markets don't have to open tomorrow. I mean, you can have extraordinary events. So I think to some extent you can get some of the instruments that people don't understand very well that have a lot of firepower in them.
Like
and
the volatility index
can
and
trigger.
things that are tied to that.
The idea of people taking a position, and they're gambling. They're not investing. Nobody's investing when they buy, some supercharged index on, on how the VIX does or something like that. They don't need it in their life. It's
Number 9, avoid borrowing money. Warren Buffett strongly disapproves of using debt to invest in stocks. He believes that when individuals borrow money for stock investments, they expose themselves to the market's unpredictable and sometimes violent swings. This applies even to stable stocks like Berkshire Hathaway. It's wise advice to avoid borrowing money, primarily through loans, for stock market investments. In a recent CNBC interview, Buffett emphasized the folly of borrowing money against securities, deeming it crazy to jeopardize what you have for what you don't truly need. He debunked the notion that doubling net worth leads to greater happiness. Sharing wisdom from Vice Chairman Charlie Munger, Buffett highlighted the 3 paths to financial ruin: liquor, ladies, and leverage, with leverage being the genuine peril. In his 2017 annual letter, he cautioned against the dangers of debt, using Berkshire's history to illustrate short-term volatility obscuring long-term value growth. Over the last 53 years, Berkshire has faced multiple stock declines of 37% to 59%. Buffett underscored this data as a strong argument against borrowing money for stocks, emphasizing the unpredictable nature of market fluctuations and the potential impact on decision-making in the face of unsettling headlines. On our number 10 spot is a fact that you never expected to hear from Buffett. Number 10. Treat your business like a marathon, not a sprint. To secure lasting prosperity, ensure your business model is sustainable for decades, not just short-term gains. Do your best to prevent burnout by adopting a balanced work schedule and prioritizing work-life balance. Despite the demands of managing Berkshire Hathaway, Buffett, with his hectic schedule, was actively engaged in his children's lives. Regularly attending school events and dinners, he exemplified a commitment to family amid professional responsibilities. One incident vividly reflects Buffett's marathon mindset. Teaching his children patience and long-term thinking, He planted a tree in their backyard. He explained that the tree would grow slowly over the years, like investments and personal development. As time passed, the tree grew taller and more muscular, embodying the enduring power of patience and long-term vision. This lesson instilled in Buffett's children the importance of sustainability and gradual growth, emphasizing the value of steering clear of short-term gains. The best time to start investing was 20 years ago. The second best time is now. Please subscribe below and let's enjoy the journey together.